Well, everybody, I think it's about time to start. I got a lot of information condensed into one session, so I don't want to waste any time. I want to make sure that I have some time for questions for you all as well. So thank you very much for coming to my session. This is a very good turnout. I'm very happy about that. Today I'll be taking you through, my journey of optimizing payment routing and how we're going to enable efficiency when we're talking multiple payment methods. A little bit of background about myself. I've been at Adyen for a little over 4 years right now. I've been all over the company, really. I started in a payment insights product, worked very briefly on our banking framework. I set up the regulatory tax reporting product for Adyen, so think filing of 1099 forms. And now I've been in acquiring for nearly 2 years, which I'm still very happy I'm in because it's a super exciting space. Before Adyen, I've worked at 2 other major banks in the Netherlands, and I also did my master thesis at one of them, which was in data science. And I moved to Chicago for Adyen about 3 years ago when we founded our Chicago office there. So that's a little bit about me. What I'm going to take you through in this session today is we're going to start with a little bit of acquiring context, whether it's as a refresher to people or just a complete introduction. I want to make sure that we got the basics down. I also want to talk about the concept and the strategy behind payment routing. What is it? How do we optimize for it, right? I want to take you through an implementation. This is more of an example of how you can put it into your solution. And in the end, I also want to show you some real-world cases where I'm basically taking you through some merchant journeys and how we've improved payment routing for them and what the actual result of that was. If you have any questions, please leave them for the end. And I've left the slide number on the bottom right, so if you mention the slide number, I can go in between them real quick. All right, without further ado, let's start off with the acquiring context. I want to first cover the payment lifecycle for alternative bank and card payment methods. Starting with alternatives, generally, they follow a relatively simple model, right? There's very little room for optimization, again, generally speaking. So what you do as either a merchant or a processor, you integrate with them, and after the integration, you can start authorizing payments for your merchants, and then you reconcile in the back. So in a diagram, what that really looks like is the shopper authorizes the merchant to take payment from their alternative payment method account, and then the alternative payment method reconciles for you. They take the money from the shopper, put it in the merchant account. Simple as that. To get a better feel for what alternative payment methods are, here are some examples. PayPal, Cash App, Klarna, ideal for people in the Netherlands. And then there's WeChat Pay and Alipay. And there are many, many more. These are just some examples. And that brings us to bank payment methods. They work slightly differently. So with these, shoppers authorize a merchant to take a payment directly from their bank account. And at least in the United States, all bank payments flow through one of the 2 clearinghouses in the United States. So the clearinghouse, which is owned by some major banks in the United States, and the Federal Reserve, which I think we're all familiar with. And then there are a couple of transfer types for these payments. There are ACH transfers, wire transfers, and instant transfers. And to go into a little bit of detail about these, ACH payments take about 1 to 3 business days to reflect on your account, and they are very cheap. They're also reconciled in batches. So if you shoot one in right now, it will happen in a batch sometime later. Then there are wire transfers. They happen on the same day. They are expensive. Generally, us shoppers are not the goal, or sorry, the target audience for wire transfers. I learned today that the average wire transfer is of $10 million in value. So yeah, I don't wire that very often. And then there are instant payments, which are basically, they take seconds to reflect in people's accounts. They are generally cheap, but it really depends on the context. One thing that's also very important to note here is that out of these 3, the only ones that are reversible under certain conditions is the ACH. Think for if there are unauthorized payments on your account. For example, somebody just took the money out. Another very important thing to note is that the Fed and the TCH are not interoperable. At least they say they aren't. They are, but they refuse to work together a lot. And other than that, they serve a slightly different purpose. TCH is owned by some big banks, mostly serving them. And the Fed is a government entity, and they want to universally serve as many banks and credit unions and what you can imagine as possible. So then, that brings us to card payments, right? So how do card payments work? Well, I am going to introduce this graph here, and I hope it's legible also in the back. Basically, if we take an online transaction, for example, we have a shopper all the way on the left. The shopper has a card that is issued by their bank or another issuing institution. And they take they take all the information on their card and type it in on the merchant website. The merchant then goes through their gateway or processor or both, and the card payment flows through the processor to the acquirer, then the card scheme, then the issuer, and then it finally hits the shopper's account. For in-person payments, this looks very similar, only now instead of filling in your information online, basically you swipe your card at a POS system, right, which from the terminal directly speaks with the processor, but then also goes through the acquirer, through the scheme to the card issuer, and all reconciliation happens in the back. So depending on who you process with, a couple days later, all this money is put into your account as a merchant, and you can now use it. With card payments, there are many, many things that we need to keep in mind. And the first of these things is all the information that's on our card, right? We have the CVC, the cardholder name, and the card number. And what's really interesting about the card number is that the first 6, or on newer cards, the first 8 digits, represent the BIN, or the bank identification number. And this BIN tells us a lot of information about what this card actually is. It tells us the scheme on the card, or the schemes, possibly. It tells us the country for which the card was issued. It tells us the issuing institution. So if we get a card like this, we know that it's Chase, for example. But we also know, based on this number, whether it's a premium card or not. And there's even more information on there. It really depends on the issuing institution and the scheme, what they provide. So we can, if we are talking payment routing, we can use all this information to our advantage when we get presented one of these cards. Now, generally, we know which scheme is on our card, right? Because there's a logo on the card. So for example, this one is a Visa card. But there might be hidden schemes on your card. So especially if in the United States, when we're talking about debit cards, there is an amendment to federal law that has gone into effect recently which mandates that every card that has a signature network on there, every debit card that is, must also have an unaffiliated network on the card as well. Usually those are not printed on the card. So what that means is that if you get this card and it shows Visa and you know it's a debit, it will definitely also have another scheme on there, such as Maestro or Pulse. It could also have an affiliated scheme on there, like Visa and Visa's Interlink, but then it also needs another scheme on there that is unaffiliated with Visa. And of course, this gives us more options to route our payment, because now we don't only have to go to Visa, but we could also go to Pulse, for example. So we have more options. Apart from that, another technology that's really interesting for cards is card tokenization. In principle, with card tokenization, we take all the details on somebody's card, and we go to the card network and say, hey, we want a new number for this card that we can only use at this merchant. And what's really nice about that is we have an added layer of security. So this card number is not the actual card number. It can only be used at that merchant. And if this card number is compromised, for example, we can just revoke this card token without having to completely renew the card and issue a new one. What's also really interesting for the merchant is if the card token is used in a payment that is initiated by the customer, there's a liability shift in acquiring terms, basically saying that if there was fraud with this token, but the customer initiated this transaction, instead of the merchant and the acquirer being liable for the funds, it's the issuer who is liable. So that's really nice for the merchant and the acquirer. Cool. Card tokenization is really interesting. It's a really cool concept. I could speak on it for hours, but I think we've had enough context for this session. One other thing to keep in mind, if you use wallets such as Apple Wallet or Android Wallet, the cards in there are tokens that represent your actual cards. So that's also what card tokenization is used for. Cool. So coming back to this graph, we see that there are a lot of parties involved here. There are a lot of parties that our payment flows through before actually hitting our card holder's account. And with payments flowing through all these parties, we might get a feeling for that there must be a lot of room to optimize, right? Well, Stanley agrees with me. There's a lot of room to optimize. A couple things to keep in mind, right? Each step of the card payment bears a cost. All the parties want their fair share. Each of these parties might have their own rules, right? Some schemes have different rules than others, even if they're on the same card. But also, our payment can fail at any single step of the payment in its life cycle. So this also helps us establish a list of optimization possibilities. First of all, we can optimize for cost, mostly keeping in mind the interchange fees, but also the scheme and the processing fees. We can optimize for authorization rates. Some schemes or some issuers, depending on some factors, might have higher authorization rates. We can also optimize for fraud and security. If we're dealing with multiple processors, some processors might have better fraud detection systems for certain merchant categories, for example. And finally, one thing that we always have to keep in mind are geographical and regulatory complexities. That's just something we can't ignore and we always have to deal with. Cool. It actually really seems like most of that's set in stone, right? There's just a card network on the card, we followed that, and then we stick to the law and we can call it a day. So how do you mean we can actually optimize for this? Well, that brings us to our next chapter. Let's talk payment routing optimization. And I've defined it as follows. So payment routing optimization is the automated strategic process of directing transactions through a network of gateways, payment service providers, and acquirers to maximize authorization rates, minimize fees, or both. And I'm talking multiple processors, right? Multiple payment service providers, multiple gateways, and multiple acquirers. Why don't we just use one processor and call it a day? Sounds simple enough. Well, like I said a little bit earlier, right, each processor has its own advantages, right? Some are better in processing certain card types. Some have better fraud detection for certain merchant categories. But some might also deal with local compliance for you, which can basically abstract that away from you. And if you don't have the resources to build out a completely compliant system in that region, for example, they might be able to abstract this away from you and take care of that for you at a cost, but it does help. So with that, I want to establish the key objectives for payment routing optimization. We want to reduce cost, increase authorization rates, prevent fraud as much as possible, enhance redundancy and resilience so that we can always keep taking payments for our merchants and they never have to say, sorry, shopper, but we couldn't take your payment. And we want to stick to compliance and our local acquirer preferences. Zooming in on these a little bit closer, we start with optimizing for cost. We've seen each of these parties here in this graph, they take a fair share of their fees. Some do more than others. So in some cases, we can optimize for that and maybe bring down the fees a little bit while not sacrificing our authorization rates. So for costs, one strategy would be least cost routing, or LCR for short. The principle for that is routing each transaction over the route that has the lowest total cost for that specific transaction. A challenge here is fee structures are incredibly complex. Fee structures basically tell you, okay, if I have a payment of this type with these parameters, it's going to cost you this much based on this many factors. Could be hundreds of factors. And of course, we need to do these comparisons in real time, and we want to keep our shopper waiting as briefly as possible, because if they have to wait 2 minutes, they've probably already walked out the store. So, how it works. Basically what we do is we consider all the transaction details that we have, card type, currency, country, amount, any other factors that we can think of, and then based on those details, we're going to estimate the interchange scheme and acquire fees as best as we can. Once we have all this information for all of our possible routes, we compare these estimated fees, and we say route B was the best because it's the cheapest. Well, that's LCR. But there's also optimizing for authorization success, of course. And from here on out, I'd like to introduce the term intelligent routing for this. The principle is we want to prioritize routes based on historical success rates to maximize approvals. The challenge here is we need a lot of historical data, and we only really get a general idea of success because of many, many factors, right? If we decide to only route over route A and never over route B, then our prediction is going to be maybe not that accurate. So a couple of ways we could go about establishing this information. Waterfall routing, for example, we always try to route the payment over the primary processor first, which is often the cheapest, right? Depends on the decision we've made. And then if that fails, we retry on another processor until we get a successful authorization. It's pretty expensive because even if your payment fails, all the parties that it has gone through will impose a fee on that payment, and your merchant might not be that happy if you pass all that through to your merchant. So you got to be somewhat careful with that. And so an alternative is A/B testing. I think something that, in principle, most of us are very familiar with. So we try to establish parameters for which payments are very similar, and then we basically say, okay, this time you go over route A, this time you go over route B, and then once we have all that information, we dynamically adjust how we route our transaction. Now, this quickly becomes pretty messy if we're not using machine learning because, well, we've basically set up all our decision making manually, and that we have so many factors to factor in that that's going to be, well, messy. So let's talk about gathering all the information we need to build a good model and to have it do good predictions for what the best way of routing our transactions is. I want to bring you back to the BIN data. So the BIN on the card really gives us a lot of interesting information that we can use, right? There are the schemes on the card issuer, issuing country, keep on going. There might be different rules for specific schemes on there as well. So if we keep this in mind, we at least already know all the possibilities of acquirers, of schemes that we can route over. So that's one thing. And then we can also exploit the co-branding, right? If it's not only Visa, but also Maestro and Pulse on a card, maybe we can consider going over Maestro because their fees are a little bit lower, but their authorization rates are a little bit higher, right? Those are things we can factor in. There are also some other things that we need to consider here. So it's usually only the signature cards that allow overdrafting somebody's card. And so Pulse would, for example, not support that. So if you try to overdraft somebody's account on the Pulse scheme, they will basically refuse it for you outright. Just a couple of things to keep in mind. Card tokens are also really interesting, right? I told you about how cool they are. What's also really interesting here is that we can usually tell from the card number whether it's a token or not. And what we should keep in mind too is that if the original PAN has multiple schemes on the card, that doesn't necessarily mean that the tokenized PAN has those multiple schemes on the card. So you could have a Visa Pulse card on the PAN that has only Visa on the token. Something you need to know, because if you'll try routing it over Pulse, it will fail outright, but you will get a fee imposed. Cool. We can't always use a token because we might not always have one, but when we can use one, they offer a lot of benefits, right? There's the liability shift for our merchant. There's enhanced security and lower fees, and there are higher approval rates. In a perfect world, the liability shift only happens on the signature networks because of a very sneaky thing that the signature networks built into it, and experience has taught me that the higher approval rates are more a fairy tale than actual reality. It's still relatively close, but you know, a 1% in authorization rate increase can mean a lot for your merchant. So that tells us that sometimes it's better to use the PAN. If we can, and we have both the PAN and the token, great, we can make a decision. We don't always have that, so we'll just have to use the cards that were dealt. Cool. What more? Are there more things that we can consider for intelligent routing? Well, we can apply some strategies for scheduled transactions, for example. Think of Netflix taking money out of your account to pay for your subscription. Well, if during the day transaction volumes are very high, why don't we do it after midnight and we use a less stressed network and there may be fewer errors, you know, that kind of stuff. We can also play around with the data elements. We've learned that even though we're speaking ISO 8583 to every network, that some issuers have difficulty using the card expiration date. So if you just omit it completely, all of a sudden your authorization rates go up, even though it's a mandatory field. Very weird, very weird. But it's, you know, it's something to play around with. We can also consider recent dispute activity. If we know that our merchant has had a lot of chargebacks recently, why don't we prioritize dispute fees up front? Because disputes are very expensive for our merchant, right? And we just want to hedge them for that a little bit. Furthermore, there's also load balancing, of course. If we have multiple connections to Visa and one of them is very stressed, why not also route it over the other one so that we don't overload those connections? There are many, many ways to experiment, and I would just say get creative, because that's the best way of learning how this works. Cool. So finally, there are also some unavoidable routing restrictions. Compliance is non-negotiable. I already said it. Depending on where you process, but also where somebody's card is issued, you have to stick to compliance. There are many things to keep in mind. Generally, after you've established all the rules that you have to stick to, it's relatively simple. Stick to them, and you'll be fine. If you don't, you might lose your license, your merchant might lose your license, or in case of scheme compliance, the scheme might tell you, we don't want you to process with us anymore, or we're going to fine you very hefty. Some other non-negotiables don't necessarily have to do with compliance, but some merchants have their custom pricing set up with networks or exclusivity agreements, and sometimes merchants have a preference. They always want to route over one specific network, even if that might not be the better option. That all depends, but you got to honor all of this, and there might be many, many more. Cool. That was that for the concept and the strategy. Let's look into an implementation, and I'm going to take y'all through an example implementation. It's going to be a very simple one, but it's supposed to give you an idea of how we can build this into our own payment processing flow. So what we're going to do is we're going to build a payment service provider with a routing optimization built in. And what that's going to look like is basically everything that comes in from the web, all the payment requests come into our payment gateway, which speaks with our risk engine, our token service, and our routing engine in that order as well. And then in the end, of course, it also stores all the transaction information in a ledger, because we have to obviously keep track of everything that happened so that we can reconcile. So let's start off with the API. We just basically get our basic methods ready for handling payments, at least authorized in there, right? But also everything else that we need to process payments very well. So when we look and zoom into our authorized method, we start with a couple of steps. First, we need to get the card details from our payment request, because this is going to reveal to us, first of all, what kind of card we're dealing with and how we can route. And what we're going to do in our bin lookup service is we're basically going to look up all the information we have on the bin that is on card. I've abstracted that away a little bit here, but generally what happens is every so many days, each network sends you their updated bin data. You just have to load that in, and then you have like a plethora of information about anything that their bins can do, all their capabilities and all their restrictions. This example here, very naively, just picks the first network that we found for that bin, and then we shoot it over to the card processor, and we return what they did. In a nutshell, that's generally what we do when authorizing a payment. Now, of course, this is very simple, so we want to add something, the risk engine. In the risk service, we're going to take all the information that's on the request, right? So we have the transaction data, but also merchant and metadata. And we're going to feed this to our risk engine that we've trained already to basically assess what the risk for this is. And we're going to assess a risk score. Is it low, high, medium, very high? And then we or the merchant can set their risk appetite that they want for this, for transactions, right? Some might have a higher risk appetite than others. But we, of course, need to take some information into account. So what do we see in the transaction data? We have the amount and the card details, of course, but there's a lot more. We might have token data. We might have both the card details and the token data, and there might be terminal data as well, telling us that a card was present, for example. These are all really important things to keep in mind. Card present because generally lower risk. Then for metadata, metadata is incredibly important too. We have an item potency ID. If we see the exact same item potency ID show up 10 times in a row, maybe something was going wrong and maybe we should stop honoring this transaction for now just so things can level out. But there's a lot of stuff as well, right? The payload checksum is something that's super important as well. Some DDoS attacks might not be that sophisticated and might try to give you the exact same transaction information a million times within a minute. And then you also know, oh, this is pretty risky. It's most probably fraud. Merchant data, super important, something we always have available. This isn't only important because we want to know, for example, okay, the shopper always shops for clothes with this card and all of a sudden they're doing a lot of gambling. That is one thing, but we can also use this data to determine whether the merchant might be committing fraud because as a processor, that is also your responsibility to assess and to block their transactions if you see that, for example, they're starting to money launder. And then there's also the shopper fingerprint. So now this one is a little, this one's always up for debate. It also depends how much resources you have available and how many merchants are under you. But you can create a shopper fingerprint even if a shopper shops at different merchants. So for example, if you see the same card show up at different merchants and then you see behavioral patterns, you can tie these all together and see, oh, hey, this shopper always shops from this IP in Colorado, and all of a sudden, this shopper is trying to ship something to North Korea. That sounds kind of fishy. So a lot of information to keep in mind here. These are just examples. So coming back to our assess risk method, those were just some examples of the data that we use to determine whether it's safe to carry on. So when we then go back to our authorize method, we can nicely embed it in this code and just say, okay, let's assess the risk. And I did it very naively over here, just saying if it's a larger risk score than high, then we're going to just outright refuse it. But you can set up rules for this. You can have your merchant set this up. It all depends on your setup. Cool. That was risk. Let's move on to tokenization. So for our token service, we're going to do a couple of things, right? If we manage tokens, what we can do is we can, for our merchant, store these tokens, give them back a token reference, which is not the same as the token itself. So there's no card number, there's no card information there. But they can use this reference to come back to us in the future and, again, process a payment using that token. We got tokenized, which basically says, given these card details in this network, I want to get a token for these card details. Store that token in our token vault, nicely secure, and then return the token reference. And there's also the detokenize, which is important in cases where we have both the PAN and the token available, and we want to determine which of these two is better, and then use whichever path we chose. So that was that in a nutshell. Putting that in our authorized method, basically what we do is we ask the token service, do we have a token available? If we do, put the token on the request, and then talk to the card processor and process this transaction, and then return that response. We can then also serve, tokenize, and get token details to our merchant so that they can get this information whatever they want. Why this is nice is because say you're a new merchant or you're running a promotion and you do not immediately want to take payment from your customers, but you want to store their card information already, you can just store the payment without actually taking payment from the network and from the shopper, so it doesn't show up their account and you don't annoy them. So with that, now let's get to the routing engine. In the routing engine, I wrote this method called find optimal network, and basically what we do is we gather all the information from the previous steps that we already had. So that's the BIN details, the token data, but also the risk score, and we pass the request as well. So there's just a whole request. We get all this information together, and we also gather the cost data. So in our routing engine, we should now know, okay, what are the fee schedules that might apply to this payment? But we also get all the restrictions so that we know whether we can take a route or not. And then we call our machine learning model to basically rank these options. And I say rank because I don't just want to get only the first best option available, but I want to get all the options available out there scored based on whatever your preferences are, right? So if you want to go for cost only, you do it based on cost. If you want to do it on authorization rates only, you do it on authorization rates, or a combination of those or more. And why we also take the risk score into account here is because we know that some acquirers and some schemes might have stricter fraud detection than other schemes or acquirers. And why that's interesting is because maybe the merchant's appetite is, their risk appetite is for high, and we get a transaction that's high. So it's a little bit debatable. Should we go on with this, yes or no? We can basically just say, well, if we don't process this transaction, it's definitely missed revenue. Let's also ask for the opinion of the scheme or the issuer. So that's why we also want to take this into account. Cool. Well, again, naively, but putting this into our authorized method, we get all the routes that are possible, and then we're going to loop over this list that we've gotten, and on the first success, we just return the result. Why you don't necessarily want to do it exactly this way is because if this is going to retry 10 times, that means your merchant's going to be hit with fees 10 times if it's refused every single time. So you're going to probably have to set some limits on there, but retrying is perfectly viable and something that I would also recommend looking into, absolutely. So what that gives you is this. This is everything put together. Again, it's pretty naive and a very simple example, but it should give you a little bit of inspiration on how to get your payment routing into your framework. What we have is a very simple version of a payment surface, but something that we can keep building on and just, making every single component of this more sophisticated and getting better results through it. And one thing that I've done for you guys, and you don't have to rush to take a photo of this because I'll bring this slide back later, but I've created an example routing project in Java on GitHub that is free for everybody to download that you can play around with. There's some test cases in there as well. As I said, I'll bring this slide back. So that brings us to the last chapter. Let's look at some real-world cases. What I really want to cover here is how payment routing optimization has made a difference for some of our merchants, but I'll get back to it with a disclaimer in a little bit. So to reiterate on all the key benefits is cost reduction is something that we can achieve here. We can achieve improved authorization rates. We can prevent as much fraud as possible. And we can have enhanced redundancy and resilience. And as well, we are compliant and stick to local acquire preferences. Zooming in on these, why these are such benefits? Well, if you look at it this way, right, an average of a 5-cent reduction in fees per routed transaction means that, depending on the scale of your merchant, of course, but pretty quickly comes down to thousands of dollars a month if they're doing quite a bit of volume. And it could even be hundreds of thousands if you're a very big merchant. For improved authorization rates, well, every transaction that gets rejected is no revenue at all and only fees, right? So a conversion rate uplift of 0.2% to 1.9% means that merchants really quickly see their revenue grow and lower fees, because even if we retry a payment, fees will be higher. There will be no missed revenue, but the fees will be higher. For fraud prevention, I think this one is pretty obvious, right? I mean, merchants can they might have to deal with costly fees. They might lose their merchandise. There are a lot of things out there. We just want to have no fraud, basically, in a perfect world, absolutely. Then for redundancy and resilience, if we can eliminate single point of failure, we can make sure that there's always an alternative available for our merchants to process payments and not miss out on revenue. And for compliance, sometimes there's only one way to go. It's very simple. You got to stick to compliance, and you got to route the way that the law tells you to. So coming back to that disclaimer, before I really dive into the examples, for the sake of this session, I have really focused on data that I know well and that I know well to explain. I've, for obvious reasons, hidden exact merchant information, and I use indications rather than exact numbers. I've also left out the numbers on fraud. And I do this because I want to give you an indication of what payment routing optimization can do, rather than try to sell you on a product that we built. So this is really for an inspiration, for inspirational purposes. Let's start with our first example. So we have a large rideshare service. Summary on them: they operate internationally, but only online. They do millions of transactions a day. And what they want is high conversion rates with low fees. Who doesn't? And they want a great customer experience. It should be completely seamless. They also have a special goal, and that is they want to have as much leverage over the signature networks as possible, because they want less monopolistic standards in payments. They're very adamant on this. So zooming in on them a little bit, if they process over the signature networks with cards, they see fees of around 1.3 to 2.5%, while over US debits, that is 1.3 to 1.7%. So that's, especially on the higher bound, a pretty significant drop. What's interesting, though, remember we were talking about tokens. For mobile payments, there is a pretty nice drop in fees on the signature networks, but what we see for the US debits, for example, as an alternative here, is that all of a sudden the higher bound increases significantly. So this is definitely something where, if we use our intelligent routing, we don't have to make these payments a lot more costly for this merchant. And then the result is basically, by prioritizing alternative networks over signatures without sacrificing their conversion rates, they still saw a conversion rate that is steady, that is at a steady almost 1%, and they got their leverage over the other networks because they can route over those. That was the first. For the second one, I wanted to look at a smaller merchant, one that's a mid-sized real estate service provider. What's interesting about them is they operate internationally, but they don't do millions of transactions per day. They do a couple hundred per day. And what they want is just low fees and high conversion. They have something unique, and that is that their average transaction value is pretty high. So you can also imagine that fees on these are pretty high, and they just really do not want to retry if that's not necessary. So for their fee information, on signature networks, it's 0.6 to 2.6, sorry, 1.6 to 2.6. And when they piloted with the US debits as an alternative, there was a significant drop, both on the lower and the higher end of the fees, about 1.2 to 1.5. Their most prominent refusal reason is not enough balance. But 99% of their shopper interaction is recurring payments. That's really interesting, because if they set up their payment processing to leverage times where users might have more balance in their account, right, with these higher ATV transactions, they might be able to avoid duplicate fees, because the shopper still owes them the money. They just have to pay the fee on the first attempt and then the retry. Well, if they do it in a smart way, they don't have to do that. It pays off pretty fast. We're still piloting with them, so I couldn't give you an exact number result. And then for my final example, an internationally established clothing retailer. So a summary on them: they operate in-store and online. They do 200,000 to 500,000 transactions a day. They want high conversion and low fees and a seamless customer experience. And their current goal is, because their conversion rates are naturally high, they just want to focus on cost as much as possible. So just to give an insight of what that looks like for them in terms of fees, on signature networks, it's about 1.4 to 2.5%, while on US debits, it's significantly lower, both the lower and upper bound. And their conversion rates are incredible. They're about 95% on POS and 90 and up on e-commerce transactions, which is an incredible result. But when they turned on intelligent routing in the way they wanted to, they saw a 1.1% conversion rate uplift while lowering their fees by roughly 33%. So they already had amazing scores in terms of authorization rates, but this was an incredible result for them. And I think this goes to show that if you do payment routing optimization right, you can achieve amazing goals. So what more is out there? We've seen 3 real-world examples, but of course, everybody in this room, you all have your own situation that you're dealing with, right? And I would say whatever you can achieve really depends on your resources and what kind of solution you are looking for, of course. If you are a processor, maybe you can integrate with multiple acquirers, even for the same network, to just see which performs better. Or if you're big enough, you might even consider becoming an acquirer and have way more control, basically take one link out of the chain. It really depends on your specific situation and your resources and appetite. So with that being said, I hope this session really serves as an inspiration for y'all, and I hope y'all start building really cool payment routing solutions, and I'd be eager to see any results. So thank you very much. I think there's a 15-minute break that starts in 1 minute, but if there are any questions, there's a microphone over there, or I'd be happy to stick around either here or outside of the room for questions or discussions.
How do you account for 3DS in your model?
Right, so the question was, how do you account for 3DS in your model? So this whole presentation was obviously very much US centric, right? There is a step that we do all the way up front when authorizing payments, where we have a decision-making mechanism that basically tells you, you have to authenticate right now or you don't. Or we try to not authenticate, but then if the network tells you you do have to authenticate, we basically go a step back. That's a very simplistic way of explaining it, but that's about how we do it, yeah.
Another question I have
Yeah.
is, for the merchant or the processor that has to deal with all of this network traffic, different network feeds, how do you reconcile at the end of the day when I'm looking at, here's my fee statement, here's all the fees that we charge. Normally, if I had just one processor, that's pretty easy. I can have to go through and understand if the fees are right. If I have multiple processors, multiple fees, multiple times a day, how am I going to reconcile to all that?
Right, okay. So to summarize your question, right, so if you're dealing with multiple processors and you got multiple reconciliation channels coming in telling you how much your fees were, how do we check that with what we estimated, right? How do we compare that? Yeah, well, it's not simple. because especially as you grow bigger, right, there's more volume that you deal with. So there's a lot you got to do and a lot of comparison you have to make. So what we do is all of our payment estimations that we do up front, we store based on the route that we picked. And then when reconciliation comes in, usually the next day, we take all of that back to what we have done and then bring it back to either our model or sort of an in-between step that we have. Depending on which network you're dealing with, you either get the exact fee incurred in your reconciliation file, or you get an indicator on where on the schedule you can find your exact fee. So those are just things you have to build for. It's not easy. It's a lot, but that's how we do it. And I think if you want to do it really accurately, there is no way that you're going to avoid reconciling line by line, which is also something we do. So I would recommend that. It's a lot of work, and it's a lot of strain on your machines, but yeah.
Also, like if you are using multiple processors, and if you're using a single processor, you might get a benefit on the volume, right? If I'm using a single processor for millions of transactions versus using 10 or 3 processors for 2,000, 5,000, 50,000 or whatever volume.
Right.
Volume concession will be there if you're using same, and the reconciliation burden
Right.
will also be less because you have to only handle the word processor, right?
Right. So you're talking about basically the burden of, the relief of burden when you're processing over multiple processors, right? Doing a lot of volume on a single processor, and then maybe the burden on other processors might remain high, while on the other you have a volume discount. Yes. Yes. You do. It really depends on your situation, and I think that also comes with growth, right? If you are experimenting as a merchant and integrating with multiple processors, that is a very conscious business decision, and you're always looking at the numbers that are a result from those decisions. So, yeah, it's running a lot of numbers every day. Yeah.
Okay, one more question.
Yeah.
So in this scenario, you have discussed on your processor, or you are thinking about becoming acquired. But let's think on the lower side.
Mm-hmm.
If you are not a processor or becoming acquired as a small business, you are using a processor like Adyen or anyone for your transactions where you don't have a vendor table, right?
Right.
You don't have a vendor table with you because whatever transaction happening is all due to the processor. You don't have any information. All these methods will not work in that scenario, right? For optimizing the fees and all those things because you don't have any data for that. For any
Right.
application or anything.
Right. So basically what you're saying is you do not have, as a smaller merchant, you might not have all the information available to do this payment routing optimization yourself.
Stage of my business and I don't know will I get a volume or not. I'm starting and I'm growing business, but
Yep.
then these processes will not work in that scenario.
All the concepts that we covered here will help you get a better understanding of what's happening under the hood with whichever processor you go into business with, right? So you might not have all the information available that a big processor has available, but especially as you grow bigger and you as a merchant might get an exclusivity agreement or pricing agreements with a network, you do get access to certain information.
Is there any way to handle the request sent to the processor that please handle this in this way? Is there any processor provide that information? Like, can we provide information to processor and get benefit of that?
Can we send a specific request to the processor, which also indicates what route we want to take, for example? Yeah, you can. We do. Yeah, no, so it depends on which processor you're with. I mean, I'm very familiar with our product. I'm not 100% sure with other processors, right? But I know that we do it, and we always honor that. And there are multiple ways that we configure that. You can do it on the fly, so in your payment request, but you can also do it in your configurations, in your account configurations, basically. So that all depends. Cool. I saw one question over there, yeah.
What percentage of your requests are reduce my payment, my fees versus make sure that the authorization is
So what percentage of our payments are the least cost routing strategy versus authorization rate strategy? That's a very good question, and I don't have an exact answer for you for that. Just, I really wouldn't be able to give you an accurate. Sorry, I don't know. But I do know that we get a lot of more complex strategies implemented. So it's not all of them are as simple. Some of them take a lot more factors into account. All right, with that, I'm going to wrap up so that the next speaker also has enough time to set up. I want to thank everybody for your attendance. Thanks so much.